the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm Remy Blaire, and joining me on this Friday to weigh in on the latest jobs report is Tai Wong, independent proprietary trader. Happy Friday to you, and what a jobs report today, Tai.
Really, really. Well, first we have to remember that it's National Vodka Day today, the world's most popular drink, and you know, probably Russian or Poland, they still fight about who discovered it, but let's get right to the jobs report. I was sitting at my desk just at 829.59, and I always watch the gold price because I'm an old gold trader, and I see gold go boom. I'm like, that must be a big number because that's the market. The machines react in milliseconds, and meanwhile I'm looking at the blinking update and I see 254. I'm like, wow, that's a big number.
Yeah,
that
what a blockbuster number.
Yeah, the market was looking for something like 150 was the consensus. That's a big number. I take a look at the unemployment rate. That actually fell 4.1% from 4.2, and participation stayed the same, which is really interesting because that means, actually it wasn't because participation shrank, the denominator shrank, it was actually fewer people were looking for work. Average hourly earnings were up. Hours worked were down a little bit, but hourly earnings were up. And here's that, for me, the real kicker. The revisions were higher for the past couple of months. And I can't remember the last time we've seen that. It's been quite a few months. Revisions up for the past 2 months were up over 70,000 jobs. So the last month I think was about 20, and the month before around 50, which that weak July's report that really right after the July sort of the meeting that got the Fed really ready to cut wasn't as weak as expected, and you could see the market react immediately. Bonds absolutely slaughtered. I think the 2-year yield must be up. Last time I looked, maybe 13 or 14 basis points. The entire curve is shifting, and that steepening trade that we've seen, where the front end of the yields and the front end drop much more quickly than say the 10 and the 30 year. That's narrowing a fair bit right now, and stocks reacted quite positively initially, but now we're sort of flattish, up a little bit. I like to see where that really closes, because now this changes the outlook a little bit for the Fed. The Fed funds futures, which we're looking at just before, about 65-35 in favor of 25 versus 50 basis points, is now 95% for 25 basis points only. So pretty much this removes the cover for the Fed. We had good JOLTS data. Now we have a very strong employment report with higher revisions. Removes the cover for 50 basis points. So we'll have to see where it goes. We have CPI and PPI next week. It wouldn't surprise me, though, certainly not the base case, where if those come out a little perky, there'll be some people calling for, you know what, we got 50, maybe they don't cut in November if inflation looks like it's perking up and we have a strong employment report. I don't think that's the way they want to go. I think they want to go slow and steady because the rate is above their neutral rate, but this is a little bit of a game changer how strong that report was.
Yeah, and as Tai mentioned, the non-farm payrolls figure for the latest month showed a gain of 254,000 in September, and apparently that's higher than the average monthly gain of 203,000 over the prior 12 months. And as Tai mentioned, we did get that unemployment rate coming in at 4.1% and the non-farm payrolls revisions. And I think when we look at the different industries where there was most hiring and where we got a contraction, I don't think that was surprising, was it?
It was really, we gained almost all across the board except for manufacturing jobs. Manufacturing jobs fell, and I think that's become a big issue in the election. I mean, as a matter of fact, this payroll report will probably help help Vice President Harris, because they'll say, well, the economy's doing great. Meanwhile, I think former President Trump will talk about the loss of manufacturing jobs and concerns about inflation, which has been pretty effective for him. But this is certainly, I think, a welcome report for the current administration.
And as Tai mentioned, it's very interesting to watch the major U.S. stock averages on this Friday morning. Initially, we saw a strong gain for the majors, and right now we do remain in positive territory, but we saw the Dow Jones Industrial Average come near flat earlier today. So let's take a look at where we're trading. The Dow Industrials are still higher by over 90 points or 0.2%, and the NASDAQ is maintaining session gains as well on this Friday morning, up by over 130 points or 0.8%. Meanwhile, the S&P 500 is also higher as well and up by 0.4%. So, Tai, interesting action across all markets. I know that we're going to get to gold later in today's session, but another headline that we've been watching are the ports, right?
Yes.
The port strike actually came to an end, and we were talking about it yesterday. So it really makes you wonder what really went down here.
that was a big surprise. It was in the evening, and I was just sitting in front of my screens. I see that popped up, and really? They settled it? I was very surprised. I thought it was going to go on. Certainly the rhetoric from the head of the union said, we can do this, we'll cripple this, this country. The sense I got, and actually they've postponed the strike. They've kicked the can down the road. They agreed on a 62% raise over 6 years. I'd like to have that, just saying, over 6 years. And then they're going to discuss things. They have until January 15th, which puts us well past the election. So trying to figure out what really happened there. I wonder if certainly the Biden administration is playing the game where they're saying, in public, we'll praise you to high heavens. I'm the most pro-labor president, and I'm not going to use Taft-Hartley, and that hits the notes that he wants to hit with organized labor, which is less sort of a solid blue wall as they have been in previous years. But on the side, they might be saying, listen, you've got to settle this. We don't want this a month ahead of the election. We don't want stories about people running out of toilet paper or fresh fruit or anything like that. And actually, I also have to say that the past few days, there's some unsavory reports coming out about the union leader, where they flew a drone over his house, and maybe we have the New York Post to thank for that. He's got a really nice car in the driveway. It's a beautiful house. He's making $1 million as head of the union, while his workers aren't getting paid. And I think that was starting to look sort of not very good in terms of for him. So maybe there were pressures from different areas to settle the strike. In the meantime, I think everybody out the country is happy. It'll probably take us a week or so to clear, or a little bit more to clear the ships that, the 40 or 50 ships sitting in front of some of our biggest ports. But everybody's a little happy. The Christmas season will be happy. The retailers will be happy. Things will be coming back in. So all in all, I think a welcome piece of news for everybody.
Yeah, between the jobs report and the end of the port strike, today would have marked day 4 of that strike. So I think a big sigh of relief regarding the labor market, as well as the end of the port strike. And as you mentioned, we had started to read a little bit about the insider talk for the negotiations, whether we're talking about the union head and some of the tabloid fodder out there. But now we can breathe a sigh of relief. We don't have to start hoarding toilet paper or buying extra supplies at the store for the time being. So as we head into the weekend, at least for now, we can breathe a sigh of relief. But before we do that, I do want to take a look at oil prices this morning and what's happening in the Middle East, because that is something that we'll continue to pay attention to, and I'm sure the White House will as well.
So earlier this week, the Iranians sent almost 200 ballistic missiles toward Israel. Many of them were intercepted, and there were no injuries due directly to the there were a couple of injuries, and one man unfortunately died when an intercepted missile, the pieces actually fell on him, and I think he was actually a Palestinian. So Israel will hit back. It's Israel's modus operandi. They've gotten the green light to hit back from the U.S., although the G7 has urged restraint. I think they've all said that, understood that Israelis will hit back. So where they hit back is uncertain. Biden doesn't support a hit on the nuclear facilities, but they said they've been discussing oil. And so let's take a look at graphic number 1, by the way, while we look at that, Brent has been up 6 days in a row. That's European oil. That's the European benchmark. 6 days in a row to a very elevated area. If we looked at this graphic, from Bloomberg, there's Iran's oil and gas assets that Israel could potentially hit. There are a lot of refineries. Karg Island's a big terminal for them. The Bandar Abbas, I think, is also a Navy base as well as an oil terminal. And then if you look right in the middle, that green dot is the Bashir nuclear plant. Honestly, so that's why I think oil is up so sharply and will stay elevated until after Israel strikes. And I suspect after Israel strikes, depending on what it is and how severe it is, if they really come out with shock and awe, I think if it's not really, really dramatic, we're going to have a situation where oil will really drop back to not maybe where it started, but we'll lose some of this rally because the fundamental demand isn't there. It's only so long that you can have a geopolitics keep it elevated when fundamental demands aren't there. But I would say that Israel has had a history of hitting nuclear facilities. They hit the Osirak nuclear reactor in the 1980s in Iraq. I want to say 1981. And they hit a nuclear plant in Syria in 2007. And people won't say it out loud. Nobody will say it out loud, including the Arab world. But sort of everybody was happy they hit those two nuclear sites. And remember that Iran is sort of the leaders of the Shiite branch of Islam, whereas the main branch is Sunni and really don't like the Iranians, led by Saudi Arabia. If there was a strike, an effective strike against the Iranian nuclear facilities, there'll be a lot of yelling and screaming and hair pulling. But I think in the end, I think a lot of people will probably be not unhappy about it. Maybe we'll see it over the weekend. I think that seems likely or pretty soon. But for oil prices, we'll have to wait until that happens to see where we go.
And I'm sure both of us will continue to monitor the headlines in terms of what develops over the weekend in the Middle East, and we will be bringing that to you on Monday.
Absolutely.
When we're back. And before we move away from commodities, you mentioned gold, so I do want to look at metals as well.
Yes.
As precious metals. You talked about demand when it comes to oil, but in terms of gold prices this morning, as you mentioned, it is lower. So what else are you watching when it comes to the metals?
So just to talk about gold for a little bit. Well, I think it was trading 26.65 or thereabouts spot, and it was one red line immediately. It ticked down, hit a low of I believe 26.32, and then now has bounced nicely. I think there is just so much bullish sentiment in gold that you almost buy every dip. I think the retracement here may go a little bit further, but we've come up so far so quickly. We could easily go to 2600. And bounce back. We'll have to go very far to do real damage to that chart. I just don't see it happening. Silver has been near highs. Sort of not really breaking out. I think a lot of fans of silver think it should be at $40 and maybe, but not immediately. And that has been a very volatile metal. One thing I would mention is our favorite store, Costco.
Yes.
They have been selling platinum bars. Now, the platinum is a metal that's 10 times as rare. I used to be a platinum trader as well. 10 times as rare as gold, and 70% of the world's supply actually comes from South Africa. So it's not well distributed. And South Africa is an economy that has had a lot of problems with power, a lot of restive unions. So basically, 70% of the world's supply comes from a very sort of risky place that platinum used to trade well above gold, and it hasn't for a number of reasons over the years. It's just about $1,000, in part because it's so rare that if you want to build your reserves, you really wouldn't want to buy platinum because by the time you bought a lot of platinum, you would raise the price dramatically. So trading around $1,000, Costco selling them for $1,100, which is a pretty big markup compared to the $25 markup they have for gold bars.
Sure.
I just checked before this morning, they run out of platinum bars. I think $1,100 of platinum, if you have a long holding period around these these levels, if gold continues to go higher, I think platinum is probably a pretty good investment. And there are also industrial uses for it, and will be industrial uses for it, even for sort of the green energy space as well. So I think it's a pretty good investment, and it's very clever of Costco to start doing this as well, because the gold bar has been real successful for them. In terms of not so much as in straight revenue, but of interest, we're saying, oh, we got to go to Costco because it's like a little treasure hunt. Maybe you'll be able to buy gold bars. It's a brilliant sort of ploy in a way to get more eyeballs and more attention on them.
Yeah, definitely. We talked about the gold bars being sold at Costco and the limited supply in terms of how much Costco members could purchase in terms of the gold. But you explained a little bit about the supply side when it comes to platinum. But in terms of demand, you told us it's not quite a value when you're getting this at Costco. But what do you think the demand is like for this?
So the demand is, there's a lot of industrial demand for it. So diesel engines have catalytic converters too. For a long time, they used almost exclusively or very heavily platinum in their, a quarter of an ounce, a third of an ounce. But some of those really big diesel engines will use an ounce or maybe sometimes more. So there's a big demand from there. Industrial demands, so a lot of energy refineries will use that for various reasons. Too complicated to get into here. And in recent years, because palladium at one point was almost trading at well over twice the price of platinum, even gasoline cars now have been redesigned to use some platinum as a catalyst as well. So I think the underlying underlying demand fundamentals for platinum is pretty good, and I think for some green energy applications, you can use platinum more than you can use palladium. So the outlook for platinum is pretty solid going forward. Certainly demand will likely increase and not decrease, and supply will struggle a little bit, although you can certainly recycle platinum out of the catalytic converters, and there are businesses that do that and do it quite efficiently, because that metal doesn't go away. You just have to get it back out, and it's probably a 100-day process at this stage to get it out, and kind of high carbon too, but people certainly do it. When you're $1,000 an ounce or eventually more, platinum's a nice commodity. Plus, used in jewelry, and I think in the U.S. there's still some places charge you more for platinum than they do for gold, even though the metal itself is cheaper, because Americans really don't pay attention to markets like the Asians do.
Yeah, that's really interesting, and it does sound like it's a very involved process, but given the demand for it, it does make sense.
Yes, absolutely.
And while we're here on this Friday, let's take a look at what's on the calendar, at least the economic calendar for the upcoming week. So we do get a handful of inflation figures out at the end of the week out from the U.S., and we will be paying attention to that. And overseas, China will return from its holiday.
Right, and we want to see where their markets pick up from where they left off.
Yes.
Is there some profit taking, or is there sort of more buying? I suspect that the rally has a little bit further to run. I don't know if it'll run as much as it has already, and also the market has will take some time to digest. Is there more fiscal stimulus coming down the pipe, because the fundamental issues in China are very, very serious. Is this enough to really turn that ship? The financial markets love it, will continue to love it, I think, but eventually they're going to think, maybe it's not a next week issue, maybe it's a next month issue or next quarter issue. Is this economy really, going to be successful, and has it turned the corner from 5 quarters of deflation that we talked about maybe 2 or 3 weeks ago, that was so serious that the Politburo and the Standing Committee realized they had to do something about it before sentiment grew even worse than it had been. But in terms of ahead of next week, this weekend, something that important on the political calendar is former President Trump is returning to Butler, Pennsylvania on Saturday. This is where he got shot almost 2 months ago. And Pennsylvania is going to be is probably the most important state of any state in the election. In terms of the experts, Nate Silver, who's done a lot of work in this over the past dozen years or so, 538.com used to be his website, but he's on his own now, and he says, I think Pennsylvania has probably a 35 to 40% chance of determining the election, the results of the election. meaning whoever wins Pennsylvania has a 35 to 40% likelihood of winning the entire election. 19 electoral votes, and the performance there will be suggestive of the performance in parts of the Midwest. And this is the point now where Vice President Harris may be thinking, maybe I should have chosen Josh Shapiro of Pennsylvania because he probably would have carried Pennsylvania for me, and I need that state very, very, in a strong way. So certainly, I think there's going to be a lot of images, aggressive speeches in Pennsylvania over the weekend. We'll also, by this weekend or early in the week, see the results of some of the polls done after the vice presidential debate, which most felt that Vance certainly got the better of Governor Walz, and we'll see how close this election really is. I think it will have gotten closer. I don't think we'll know until the first Tuesday of November.
Mm-hmm. And speaking of which, the countdown is on until November 5th. We have apparently 31 days to go. And when we look ahead at the month of November, we'll be getting another non-farm payrolls report on November 1st,
yes,
following the blockbuster jobs report we got earlier today. And of course, the election on November 5th, followed by the Federal Reserve rate meeting at the end of that week as well. So I do want to take a step back, and given the Strong's jobs report, Tai, can you explain why we hear this term good news is bad news? Can you break it down for our viewers?
Sure. And it was interesting. We were talking about this again yesterday, and it's worth revisiting because for most Americans, for most people around the world who aren't focused on the financial markets, why is the stock market maybe a little tentative, and sometimes goes down on good news in the economy?
Yes.
And it's usually because the policymakers, the Federal Reserve, is in the middle of doing something. They want to cut rates. This report, and I don't know how the equity markets are going to finish. Maybe they take a little profit by the end of the day. We'll have a better sense probably towards the last hour of trading. But most people feel that the neutral rate is not 4 3/4 to 5%. It's closer to 4%, and they think the Fed ought to get there, if not lower. This makes it hard for the Fed to get there. So if you're concerned that this is just a 1 month pop and this delays the Fed, well, 4 3/4 to 5. If we don't cut rates more quickly, that wave of refinancings that people are hoping will put more affordable houses on the market. If you can refinance your house and you do what's called a cash out refinancing, where you built out so much equity. Let's say your house used to be worth $300,000 before the pandemic. It's now worth $600,000. If you refinance, you can get more money out. And Americans love credit. The idea of borrow and spend is much stronger here than it is in many Asian countries. In Japan, for years, the government was begging people to spend, and the Japanese no, we'd like to save. It's the same thing with the Chinese. It's sort of, save for a rainy day. The Americans don't think like that. They want to get money out. They want to spend for Christmas. They want to take that vacation. It's just that, in part why we're such a strong economy is the consumer really helps drive it. So why is good news bad news? Good news will prevent the Fed from cutting more and cutting faster. So people keep their money in a high-yield savings account. My kids are, they're 21 and 23 years old. They put money in a high-yield savings account that's returning, 4.2%. In fact, my daughter told me, "Oh, my yield on that dropped to 4.1 from 4.25." That's a little annoying. I'm like, well, they cut rates 50 basis points, so that's to be expected.
Yes.
So. So good news when the market wants the Fed to cut. The market doesn't want really bad news, but they want sort of not great news. And good news sort of is a little bit of a fly in the amber. It's unusual, it's strange, but I think we will continue to see that as long as the Fed is in a rate cutting mode, and good news is preventing them from cutting as quickly as some would like.
Well, I like that analogy and that reference there in terms of what it means for the market. And right now we are actually seeing the Dow Jones Industrial Average fall below the flat line. So
Wow,
we'll
quick.
see, it is down by nearly 15 points right now, but of course, as Tai mentioned, we will wait to see where the market closes later on this afternoon. And Tai, as always, thank you so much for joining me here on the floor of the New York Stock Exchange and for dissecting that jobs report. I'll see you back here on Monday morning. Have a great weekend. Thank you, Tai. And coming up after the break, I will be joined by Dan Ha, partner at Karani Asset Management. Don't go away. Welcome back to Global Money Talk, live from the New York Stock Exchange. This week in our Market Insight segment, we've been focusing on the tech sector. We heard from a slew of guest speakers and honed in on MSPs, analyzed different sectors, and also explored the different cycles of the tech revolution. And we were also joined by Dan Ives at the beginning of the week for a deep dive into cyber and some Mag 7 names. Well, to wrap up our Tech Week, I'm joined by Dan Ha, partner at Karani Asset Management. Happy Friday to you, Dan. Thank you so much for joining me.
Happy Friday. Thanks for having me.
Well, we're wrapping up the week of market insights that focused on tech. But before we talk about everything we've learned and focused on this week, let's take a look at economic data, especially on the heels of that jobs report.
Yeah. So until last night, frankly, I was getting a little nervous. Last week when I was here, I talked about the tail risk of inflation reaccelerating. And the Fed needing to fight that if that were to happen by raising rates. Again, a low probability outcome, but something that would hurt nevertheless because it's such a low probability outcome and that is not expected by many. All events have triggers. All bad events have triggers. They usually start small somewhere and become bigger. And, a combination of a major port strike and a potentially escalating conflict in the Middle East that could drive energy prices higher. The combination of that would have been bad for inflation and potentially could have rekindled inflation higher. Now, to be fair, I don't think the port strike was ever expected to have a really bad impact on the economy, at least in the near term. However, psychology matters when it comes to inflation. Even though, for instance, people were talking about toilet papers, right? Apparently something like 90% or more of the toilet papers that we use in this country are produced domestically, and what is not produced domestically is imported from Canada and Mexico, which means that the port strike would mean nothing to the availability of toilet papers, yet people were still talking about it. Why? Because the memories from 2020 shortages are still fresh in people's minds. So, you heard of people, friends of ours going to the grocery store to stock up because, oh, now there's a port strike and, we don't know what that might mean. And, literally a friend of ours was at Costco like 3 nights ago, and apparently line was out the door.
Oh my goodness.
So even though, analysts might think, okay, it's the East Coast ports, what are we importing from Europe? Like, how would that impact our daily spending and our daily necessities? The general public is not always going to be thinking about it that way necessarily. Therefore, this could have been the thing that rekindled inflation, especially if it coincided with rising energy prices. But fortunately, that risk went away as of last night, at least for now. And when it comes to energy prices, the risk of further escalation in the Middle East still is very much going on. But at this point, that alone probably isn't going to be, higher energy prices alone probably isn't going to be enough to, reignite inflation or reaccelerate inflation. Therefore, I basically said all of that to basically say that I feel about the same about equity markets and the macro drivers. I feel about the same today as I felt last week, but I still thought it was important to kind of share my thought process to help remind the viewers that you always probably want to be thinking about where could things go wrong. Just briefly on the labor market. Tai did such a great job recapping it, and not just today, but this entire week. I don't really have anything to add, other than to say that on balance, it does seem to indicate that the economy is still quite strong, that the labor market is quite strong, which is a good thing. I'm generally an optimistic person. When I come here, I talk a lot about the things that could go wrong. So it may sound like I'm pessimistic, but all I'm trying to do is, help our viewers think about the things that they may not be thinking about. But to be fair to myself, I'm a pretty optimistic person, a pretty positive person. So strong job market, therefore strong economy. It's something that I like to see too. So we'll see.
And I do think it is very helpful for our viewers to know what you're paying attention to, not just in terms of economic data, because some of the things that you mentioned, the port strike as well as tensions, unrest in the Middle East, they have the potential, as you mentioned, to affect so many parts of the U.S. economy. But for now, at least the port strike has ended before it extended into the latter half of this month, and we will be getting some inflation figures out from the U.S. next week. So we get CPI as well as PPI, so we'll get a better read on the latest figures out from that data point. But shifting our focus back into what we mentioned earlier, we focused on the technology sector for our Market Insight segment this week. We had 4 days of tech specialists covering a variety of topics. So now that we're here on this Friday and we can take a look back at what we covered this week, what stood out for you, Dan?
Sure. So starting with the first 2 days, between Dan Ives and Suraj Pukar of Atlas Technica, we heard a lot about vendor consolidation in software. I mean, I asked a lot about vendor consolidation because, frankly, it is a theme that we are focused on at my firm, Karani Asset Management. And basically they confirmed that view, our view, that vendor consolidation is very much underway. Um, I don't think, I don't know any business buyers of software that actually love having more and more vendors to manage. If they could, they'd like to have fewer. And some companies, like both Dan Ives and Serge mentioned, um, have to have lots of vendors. I mean, often these are very large enterprises that have a large IT department to enable that, to support that, so they could afford to have that. And second, these larger places will often, from a business risk management standpoint, require that they use multiple vendors rather than, more vendors than fewer. But that doesn't mean that they actually love using multiple vendors. It's just more to manage, more to integrate, clunkier experience for the end user. It's just not great. And nowadays, we even have software that help you manage your software, right? I mean, do we really need that? I mean, in certain situations, certain contexts, I'm sure you do. But generally speaking, it's not something that I don't think corporations, enterprises do happily. It's just something that they do because they have to. So vendor consolidation, we think, is something that is going to continue to happen. And that sort of adds to the general view that we have had of being cautious about smaller point solution type software companies. Because when you're a smaller point solution type software company, you have what we internally kind of nicknamed the Microsoft risk. It's the risk that you wake up one day and suddenly Microsoft decided to focus on your area of the business and starts competing with you. That's existential. No matter how, it doesn't matter how low a multiple you trade at that point. If you have a major competitive threat from a very large player that has large distribution capabilities, then that's existential for you. So, that's something that I would take away from the conversation. There is one, a set of statistics that I'd like to mention when it comes to this. So, out of about 130 U.S. software stocks, the median market cap of the most highly priced 1/3 currently is about 14 billion. The median market cap for the lowest priced 1/3 is about 2 billion. So that's a 7x difference. That same measured about 10 years ago. For the top 1/3 most highly valued software company, the median market cap was actually 1.8 billion. And the same for the 1/3 lowest valued software companies was 1 billion. So a difference of 1.8x. 7x, 1.8x, meaning that spread has widened over time. So 10 years ago, whether you were highly valued or you were valued low as a software company wasn't necessarily about size. Today, it is definitely, I'm not saying that that's the only driver, but there's a big component in what is driving the valuations of software companies. A major component is how big you are. Because the bigger you are, the more established you are probably, and it's probably harder for a competitor to try to come in and just squash you and just decide to compete with you. So that was a major takeaway that I'll be applying in our process.
And also, Dan, in addition to what you mentioned with vendor consolidation, we had other speakers this week, and we were able to take a closer look at some of the bigger market cap names, including Alphabet. We had Shweta from Wolf Research, and she was not so bullish on this name. What did you make of that?
Sure. So Alphabet, we actually think it presents a rather attractive risk reward right now. So for full disclosure, we own some Alphabet at my firm. Alphabet is largely seen today as a laggard, or a laggard in AI, and it's seen as being challenged by these newcomers in the Gen AI space. And the thing about Alphabet, as Shweta correctly assessed, for Alphabet, it's kind of like heads your flat, tails you lose. Alphabet is a champion currently, right? So if they figure out AI, the best they'll do is hold on to its sort of champion position. I mean, that's what's tough about being at the top, right?
Yeah.
The best you can do is hold on to your position, and if you can't defend it, then you've only got downside. So Alphabet is being challenged. There is this new technology wave of generative AI. Alphabet is, I think it's fair to say, still seen largely as being behind in that race. Therefore, the worries are, I think, warranted. Having said that, I don't think Alphabet stock necessarily is reflective of that, meaning heads you win, or heads you're flat, tails you lose. From our previous conversations, I like situations where it's heads you win quite a lot and tails you lose a little bit. Alphabet stock right now, even though the business is heads you're flat, tails you lose, Alphabet stock has derated in recent months in recent period because of these fears, and therefore is already incorporating some of that pessimism into the stock. So for example, Alphabet historically over the last 7 to 10 years have traded at about a 40% premium to the S&P equal weight, which is our preferred index to gauge the broader equity valuation levels. It has traded at roughly 40% premium on average over the last 7 to 10 years. That premium has come down to about 13%. So clearly, people aren't as optimistic about the future of Alphabet as they were a few years ago. And that clearly reflects this pessimism, this concern that the market has, which means that if Alphabet could actually hold on to its position by figuring out AI, we think the stock actually re-rates higher because it'll take away the reason for all the pessimism around the stock. And so, we actually think it's quite an interesting risk reward at this point. And just in terms of Alphabet being behind in AI, I think the jury's still out. I mean, if Dan Ives is right, who says that AI is a party that goes till it's 9 a.m. at a party that goes till 4, or 9 p.m. at a party that goes to 4 a.m. That means we're very early, right? If we're very early, I think it's too soon to say, well, Alphabet is behind. They're certainly not sitting still. They're certainly working on a lot of AI capabilities, have been for a while. And recently they've launched some really cool Gen AI capabilities, like for instance, Notebook LM is something that we internally have recently been experimenting. It's a tool, it's a very useful and impressive tool. So that's one example. Another is I think it was actually yesterday, announced some ways to place ads alongside their AI search results, or Gen AI generated search results to help the ad business so that they can continue to monetize the Google platform. So I think it's still way too early to tell. And on this point, one other thing I want to just kind of mention is the thing that I pay more attention to than even the immediate monetization opportunities, frankly, is the strength of the user base. Because as long as they have that strong user base, we think long term they'll have plenty of opportunities to monetize that user base. I use ChatGPT and Perplexity in my work, in my day-to-day. Therefore, that's one less search that I'm doing on Google and on ChatGPT and/or Perplexity. Having said that, I haven't left the Google ecosystem. The Google ecosystem is so deeply, in my life that it'll be a long time before I leave that Google ecosystem, between Gmail and, all the Google products, right? And I have two small children in elementary school. They're learning how to use Google at school. Their school is basically, they use Google Classroom and Google G Suite to run a lot of their day-to-day. And one of the first, actually the first computer project that my daughter had when she was in first grade was to use was to collaborate with a classmate using computer, and that was done on Google Doc, right? So she was telling me about how she knows how to use Google Doc and things like that. So, I mean, talk about an install base, right? They're working on this. They're continuously building their user base, and it's not just my daughter and my son's school district. I think, I don't have the latest number, but as of 2017, the number was close to 70% of all the school districts in the country were using Google Classroom or G Suite in school. And I wouldn't be surprised at all if that number was higher today. So as long as Google continues to build this very strong and robust user base over the long term, I think they'll have plenty of opportunities to monetize. Now on the downside, if they fail at that, the downside I don't think is going to be, if Google dies, I don't think it's going to be a sudden death. I think it'll be a very slow, drawn out death because of, again, just because of the strength of the user base and the strength of the installed base. Therefore, hopefully if Google fails, as investors, hopefully we'll be able to jump off that ship before it's too late, and before it's before the decline is detrimental to the portfolio. So we're monitoring closely, but the risk reward seems rather attractive in our view.
Well, it seems as though we're seeing a common thread here, whether we're talking about enterprises and vendor consolidation, or even consumer personal usage of some of these platforms, that convenience and staying within one ecosystem can be easier when we're trying to juggle different things.
Right.
So, Dan, speaking of new technologies that are also challenging today's champions, we heard from Steve Milinovic, who brought his multi-decade experience to share his views on where things stand. So what were some key takeaways, and what are some things that stood out for you, Dan?
Yeah, no, I thought Steve's interview was awesome. There were so many things to take away from that, but if I have to pick, I'll pick two things that kind of tie into what I was talking about earlier. So the first one is, he made a reference to a number of slides made and posted by Coatue, which is a very successful tech investor. And I actually brought some slides that Steve used. Can we pull up slide number 1, please? So I'm not copying Steve. It's just easier to visualize when you have charts in front of you. But so this is the S-curve that he showed, again, work done by Coatue. This is available on Coatue's website if anyone wants to go take a closer look. But even though this one in particular is specifically about AI, it's an AI S-curve, I think this kind of S-curve applies to many different technology waves. And if we actually pull up slide number 2, these aren't quite S's. But here you can see the beginning, the rise, the decline of various waves, and the key thing to note about these various waves is the fact that they overlap, or they usually overlap, and so the beginning stage of the next wave usually coincides with the decline stage of the previous wave. And if we pull up slide number 3, these are the long-term stock prices of software and semis. And while the lines aren't as smooth as the previous, they're conceptual charts, right? These are real price charts. you can see the beginning, the rise, the decline of the purple line, and then you could see the rise of the blue line. Steve talked about the 10 to 15 year cycles in tech, and I could remember 10, 15 years ago, all the conversation around cloud computing, the build out of that infrastructure, and software companies that have, up until that point, were selling perpetual licenses to be deployed on-prem, were converting their products to software as a service products. And so, here we are 10, 15 years later. It's impossible to know whether that purple line, which is a price index of various software companies, we don't know if that purple line is going to rebound upward from here, but it does seem to, so far, have followed that S curve within the 10 to 15 year time frame that we saw in the previous slide, and that just adds to the cautiousness that I have when it comes to trying to pick winners and losers among the smaller point solution software companies of today. And so, that was a very helpful insight that he shared with us. One other thing I'll share on this is if we could actually pull up slide number 4. If among our users, if they want to pick stocks within the smaller point solution SaaS type of companies, I think picking from the virtual software companies, the vertical software companies is probably better than the horizontal software companies, often called stack players. And that's because vertical software companies are the kinds of software companies that are supplying products to usually to a specific industry. So, an example is a company that sells computer-aided design software, CAD software, for engineers to help design airplanes, for instance. Not all industries are going to have or are going to use CAD software, right? The opposite of that, like a horizontal play, would be something like an HR software or a marketing software or a communication software, which is something that basically all the businesses need. But what's interesting about this is if you look at that chart, the dark blue line is actually the valuation multiples of vertical software, a group of select vertical software companies, and the light blue is a group of these sort of horizontal software companies. And the vertical software companies are valued more highly right now than the horizontal companies. And that's interesting because if you think about it, the vertical software companies typically speaking, have smaller markets because, like I said, not everyone needs CAD, but everyone needs HR software. And they're usually slower growing because more often than not, they have already penetrated pretty deeply into their respective markets, into their respective industries. So you have a situation where a slower growing and a company that is growing slower and has a smaller market that is valued more highly than a company that is potentially faster growing and has a way larger market. And that's probably because the vertical software companies are seen to be more safe, as safer than the horizontal software companies. And normally, when I'm looking for companies to invest in various industries, lower the multiple, generally speaking, the better. That means lower expectation, therefore higher upside potential. And if we're talking about more sort of slower moving industries like consumer staples or chemicals or industrials, if I see a company whose multiple has really collapsed, I would actually get pretty excited and want to learn more about it because it's more often than not cyclical fears. But in the case of these smaller software companies, the threat could actually be existential, coming from some of these larger companies equipped with Gen AI capabilities, coming for your business. And when the risk is existential, then there's really no multiple low enough to really compensate for that risk. So this is something that I thought was a helpful insight shared by Steve. And just the last thing I'll mention about the second thing that Steve shared that was important to me, at least, was his assessment that the mega cap tech companies, the Microsofts, the Amazons, the Metas of the world, weren't behind when it comes to investing in the next wave. That they're actually doing a good job, and in fact, they're even leading in terms of investments into these areas. In technology and in many places, usually it's the largest players, the champions of the winners of yesterday or the last wave that get disrupted and get dethroned. And so it's easy to think that, okay, this is the next wave, so the victims will almost have to be the mega cap tech companies. But Steve didn't spend a whole lot of time on this, but he did share that these companies were doing a pretty good job investing in this next technology wave. And to me, that's a very important input, because in our business, experience and having seen cycles really matter. And the fact that somebody like him, although it wasn't a scientific or a quantitative assessment, it was really more of a qualitative assessment, for someone like him to think that these larger players are actually doing a good job keeping up was actually a very useful input into my thought process. So I thought that was very helpful.
And Dan, as we edge closer to the end of today's show, I know that you've mentioned artificial intelligence. It's been a theme that has been highlighted across the speakers that we had on Market Insight this week. So any takeaways for you on AI?
Yeah, I mean, on AI, which obviously I have spoken about. I think I spoke about it last time, I spoke about it the time before. The most important takeaway from these conversations was, yesterday, Steve mentioned this briefly, but yesterday, or the day before yesterday, NVIDIA and Accenture announced a partnership, right? And that to me is a very important announcement, very important partnership, because that'll really help NVIDIA further strengthen its, or further deploy its products and build out that installed base that I've talked about. What Accenture is the largest and probably the most influential IT consulting firm out there. And so Accenture is now going to help its corporate customers, its enterprise customers, figure out how to use NVIDIA's capabilities, basically. What that means is Accenture is going to now go out and help its clients build applications, tools that they can use, and these tools and applications are going to be built on top of NVIDIA's technology, NVIDIA's software platform, which runs NVIDIA's hardware. So software is among the best ways to increase the stickiness of your end users. And so now the largest tech consulting company is going to go out and help the largest, globally the largest enterprise customers build out applications on top of NVIDIA that's going to be deployed and that'll be used by millions of workers, professionals out there. And once they get accustomed to using these tools, that's going to be a big advantage for NVIDIA, even down the road, even if other hardware players figure out a way to make just as good, if not better, GPUs, it's going to be pretty hard to penetrate that software installed base.
And Dan, I'm glad you focused on that announcement that came out between those two companies because it does highlight some of the key points that you mentioned. So thank you so much for joining me on this Friday morning and for giving us a summary of our speakers and guests from Market Insight this week.
Thank you for having me.
Thank you, Dan. And that will do it for Global Money Talk live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sampro TV. And make sure to check out the show anytime at your convenience on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here bright and early on Monday morning. So have a great weekend.